All right, welcome Rain King members, and also welcome to those of you from the public who are tuning in for this weekly general market update. Last general market update we had for the public was on April 4th. That's right when we started the correction. There's been a lot of change in the past month, and we've been keeping all of our members up to date with what to avoid and what new ideas are out there. So let's talk markets. All right, before we do that, remember that all the presentations by Rain King LLC are for educational purposes only. All right, let's dive in. We're going to look at the big picture a bit, and then we're going to dive into the indices, the Mag 7, and then we'll spend some time on what's working in the market and what are the next opportunities with specific stocks that may be of interest, and then we'll put it all together. All right, let's open up with the big picture here. We've been following the 1998 market as a kind of a precedent for the correction that we've been going through. I've been using this throughout the month of April. We've talked about the waves down, some of the similarities. And last week, we talked about how important it was to understand when the market environment was changing. And we also looked at the character change on the index, that the spreads got much tighter. And we also got a follow-through day that saw subsequent follow-through days. Every couple of days, there were gains of 4%, 1.5%, 1%. That consistency shows a change in the market tone and accumulation. So we wanted to burn that kind of into our brain as we started to look at the current market. Some of you have asked me, why am I using the 1998 market? Others are using 2018 and other precedents. So let me explain why I'm using 1998. So looking back at the NASDAQ, 1995 to 2000, this is a monthly chart. The market from 95 to 1998 was in a 3-year bull market. You can see the uptrend. And the 98 correction was very fast. It was a 33% decline in only 57 trading days. It was pretty harsh. And it was really driven by an event, the event being the long-term capital managed crisis, where that management company got into a lot of trouble being way, way over leveraged. And the Fed actually had to come in. So this correction was fast. Once that crisis was averted, the market, you can see, recovered fairly quickly towards the end of 1998. From there, we kind of had an upward grind. We had an upward grind for almost a year in 1999 with an upward bias. And then we had the blow off top, which 5 months is when the dot-com market went crazy, and we eventually peaked and rolled over and went into a deep bear market. I do think there's some similarities here. We've been in a bull market from 23 to 25. We've had this event-driven bear market, which is driven by the tariffs and some of the changes to the economy. I do think there's the potential to recover and move higher. Maybe it's a grind for the balance of 2025, but we could get this kind of blow off top before the market really rolls over, maybe in early 26. So that's a possibility. Some of the catalysts related to this big picture idea for 25 are really, we still see, and we've been talking about this for weeks, lopsided positioning by institutional investors that are very bearish. Sentiment at the retail level has been extremely bearish than the past 9 to 10 weeks. That will catch a lot of investors off guard. Mutual fund managers will have to start putting money to work, or they're going to underperform their peers. We also have out there the potential for a June rate cut. A rate cut there could actually be another boost to the market. That's a possibility. Besant has said that, Trump is trying to get a tax cut in place by early July. If that materializes, that could have the market rallying. And also, the 90-day window of suspended tariffs will expire in early July. Hopefully, the next 2 months here, we're going to get a number of tariff deals that are actually going to come forward, or we're going to see more tariff exceptions to the rule. So that, again, as that relief comes to the market, it could help us continue the rally. Also, I think in the big picture, in early April, there was huge uncertainty. Maybe over the next 60 days, 90 days, things will be less certain. There'll be more certain. Less uncertainty in the market would be good for the markets. The markets don't like uncertainty. So just some ideas that could be catalyst to play this out. Now I wanted to show this. This is the S&P 500. This is a monthly chart, and it's looking at all the monthly hammer candles over the past 25 years and when they occurred. You can see here that in general, when you get a hammer candle for the month, generally we've had good rallies. Here's a good rally in 04, 06. I'll come back to the great financial crisis in a bit. You can see 2012, hammer candle, great rally. Even 2014 had at least 6-7 months of a rally. 2016, we had 2 hammer candles in a couple of months, nice rally. We had a hammer candle in 2024, and we just had one here at the end of April. So they're generally a good sign. The exception is the great financial crisis. You can see there were some hammer candles in here, but don't forget, this is a monthly chart. So you can see after the hammer candle, there were still 1 to 2 months of upside here, here, and here before the great financial crisis moved lower with one of the greatest bear markets we've ever had. So this is encouraging. I think that we just put in a hammer candle on the S&P. All right, let's dive a little closer now into the indices. This is the NASDAQ on a daily chart. We've been looking at some very simple things to guide us here. We've been looking at the high volume close day here, and we've been really using the midpoint here, which from the old 2021 highs is this black line. Generally keeping this fairly simple. Above that line, we said we're going to get more bullish, particularly if we got above this close right here. And if we close below that, we were going to get more bearish. Now, look at the market the last couple of weeks. 2.7% gain on the follow-through day. 2.5, 2.7, 1.5, and we're going to be ending up closing the day today somewhere in the 1.5, 1.6 range, most likely. So there's that characteristic coming back. Now, I think Wednesday's session I thought was really, really important. The market had every excuse to go down on the poor and mixed GDP numbers. So inflation numbers were also out, jobs numbers were out, some mixed information. The market could have absolutely sold off there, but it didn't. It shrugged it off. And when the market doesn't do what you think it's going to do, in this case, I think it's actually bullish. So we've also got ourselves above the purple line, which is the 20 exponential moving average. I do think we're extended. We got above the 50. I really anticipate a 3 to 5% pullback into this yellow zone here would be constructive, and it would be very, very normal. A 5% correction from where we are would bring us right down to the 20 EMA, which coincides with this high volume close on the chart. So I think that's normal and to be expected. We don't want to be chasing stocks when things are extended. Now switching over to the S&P 500, those of you that are members, you will recognize this. I've been tracking very closely the NYSE advancers, decliners. We've had a number of breadth thrust indicators over the past few weeks. We had the follow-through day where we had 10 to 1 advancing issues over declining. We also had last week a breadth thrust, the Zweig breadth thrust, which is really rare and very positive for the market looking out 3, 6, and 9 months. And even during the week, you can see here that we've had some generally positive days. We're now 7 days above the 20 exponential moving average. I think that's just all very constructive action. So the breadth is improving. I have to say that new highs, new lows are still kind of not clear yet. We're barely into new highs. It's going to take a little time. We like to see those above 50 at least. Now looking at the New York advanced decline line, this is fairly simple, but the advanced decline line you can see here has been very strong since the second week of April. And you'll notice that if we just draw a line across the tops, we're almost at new highs in the advanced decline line. Another indication that breadth is very strong coming off the bottom. And you can see where the S&P is still way off of its high. So this is, to me, this is very strong and very, very bullish for the market. Now, looking at breadth thrust, we can look at it from a number of ways. This is actually from Carson Research. They looked at situations where the advancing issues, we had 70% advancers over decliners on the New York Stock Exchange 6 out of 10 days, kind of in a 2-week period, getting this thrust of advancing issues. And it's only happened a handful of times since 1950. And you can see we had it happen here on April 23rd. Before that, it was a couple of years ago on January 2nd, then going back to COVID. So I took a little look at some of these to see what position were the index, the S&P, in relative to some of these signals. You can see here that the signals for 1, 3, and 6 months out, they're all generally green, particularly 12 months out. So looking at those signals of a couple of them, we'll go right to left on this diagram. This is the more recent one, January 12th, 2023. The signal occurred right here. And you can see this signal, it was blue skies ahead here. It was a nice rally in the market. Going back to COVID, this is actually April 17th. Amid all the uncertainty of the markets, we had this advancing issue signal, and you can see the market went on a bull run. If we go back even to the next one, which is October 22nd of 2013, you can see it occurred right in here, and the market moved higher for another year to a year and a half. There were some corrections along the way, but you can see it was an uptrend. So those are interesting to look at, that we just received one of these signals. Again, another piece of the puzzle that maybe the next 3, 6, 9 months are going to be positive. All right, let's take a look at the Mag 7. You know, for a while it was being called the Lag 7, but things have changed with earnings. This is MAGS. This is the Round Hill Magnificent 7 ETF, which also looks at just those 7 stocks in isolation. And, you know, Netflix is no longer, I guess, part of the Mag 7, but it used to be part of the FANG stocks. Netflix is probably the strongest of these big mega cap stocks, been running and breaking out in a very impressive fashion. But the rest of the 7, and I've kind of put these in a position of least amount of tariff impact to probably the ones that have more impact from tariffs. Microsoft up huge yesterday for this mega cap stock, 9% on earnings. Meta up 6% on an earnings gap. Google had an earnings gap, it faded. Even Tesla had an earnings gap of 5% on a weak report. Amazon, Nvidia, Apple, some of those reports are coming. These are some of the best US businesses ever. The amount of impact that they have on the technology side of our country is tremendous. 42% weighting of the NASDAQ 100 is in these 7 stocks, and 30% of the weighting of the S&P 500 is also in these 7 stocks. So when these go, the market goes. And I think we're seeing the market getting some traction now that the Mag 7 has been re-engaged and starting to rally. So let's take a look at what is working and where are some new opportunities, some new stocks, names to look at. All right, let's start with this. This is the NASDAQ, and I'm plotting all of the breakouts that we've seen since the follow-through day. I always like to track this to see if we're gathering steam, and I also like to know which ones are IPOs and new merchandise. You can notice here that the ones in light blue had IPOs in the last 4 years. So I'm not going to go through all the symbols. You can, take a screenshot of this or just pause your video player, but you'll notice these are new issues. We've got Service Tightened, we got iBit, we got Sports Radar. Look at all the new issues, which is really encouraging. And you can see we're starting to get more and more breakouts every day as this rally is gaining some steam. Even today, we had Spotify, DoorDash, and Uber all break out. So I'll be adding them to the list, and we'll keep this going in successive weeks. But it helps keep you on the pulse of what's working in the market. Now, as I mentioned, the Mag 7 and the technology sector are starting to come back to life. So I looked at a couple of comparison charts here. I'm taking the XLK, which is the technology sector, dividing it by the S&P, the SPY, on a daily chart. And you can see here that we had the big breakdown we had in early April, where we broke this big kind of head and shoulders top, real bad breakdown. But we've actually recovered the levels that we broke down at. That's bullish, that maybe things are really, really turning. So that's the first thing that I'm looking at is technology relative to the S&P. And then on the right, I'm looking at XLK by itself. So by itself, we've broken this downtrend line, but there's a lot of work to go to get back to old highs. So this might grind a bit. Who knows? Maybe we go sideways and grind our way higher. But the sector seems to be coming alive again, trying to get itself into a confirmed uptrend. Now, if we look at where the real strength is building, and I take the software ETF, IGV software, and divide that by the S&P, you can see that this is even stronger than the XLK. When this line is moving up, it means software is outperforming the S&P 500. And you can see we're only 4.3% off of the February highs. We're almost at the new high there. So that's really impressive. And even stronger is HACK. HACK is the cybersecurity stocks divided by the SPY. We're only 1% off the old highs from February. So this is even stronger than software, and software is stronger than the XLK. This helps us zero in on where the pockets of strength are in the market. So let's look at some kind of top tier names that you might be in or maybe on your watch list. Palantir has been acting like a true champ. It's really, really been good. Now we have earnings coming up on Monday, May 5th. So that's something to be aware of. We, in our focus list videos, we had members getting into the stock at 100. And so far they're up 22% on the trade, but that's all pending the reaction to earnings on Monday. CrowdStrike is also another strong stock. Been very, very strong lately. Earnings on this one is not until a few weeks. We've got until May 29th. But the stock is, again, cybersecurity is very strong right now. And CrowdStrike is certainly one of the leaders. Right below that, we have another leader, Zscaler, which actually broke out this week. Its earnings are still at least 4 weeks away. So we've got some time with that one. And also Robinhood. Hood has actually been acting well, starting to break out of a double bottom. The earnings are out of the way for this stock. I will disclose that I have positions in Crowd and Palantir, but the software cybersecurity looks strong. Here's some more names to keep on your watch list, or maybe you're in these. Roblox. This one broke out a couple of days ago, had a good earnings report, and it's continuing to add gains today. So the earnings are out of the way. Netflix, as I mentioned, being a subscriber-based model, they're really pretty much immune from tariffs. So I think a lot of institutional money is plowing its way into a big liquid name like Netflix. You can see the overwhelming volume coming in and the persistency of the advance day after day. So that's very positive. Down below, we have an interesting one. This is Spotify, which has already made a big, big run. And this is actually kind of a late stage basing structure. Well, they had their earnings a couple of days ago and it gapped down initially, but you can see that it's being bought up and it actually broke out today. So the fact that a weak initial reaction has turned itself around and gotten back above the breakout level is a positive. So Spotify's earnings are out of the way and it's starting to participate in the rally. Moving over here, we have DoorDash. DoorDash is in a nice little double bottom that broke out today. Earnings, though, are coming up soon. We have earnings next week, May 7th. And a couple other names for your watch list. This is C Limited. I like this one. It's also acting pretty strong. You can see the strong recovery after touching the 200-day line. Earnings are 2 weeks away, May 13th, so you have to keep that in mind. Another piece of new merchandise is Karman Holdings. This is a stock that makes parts for the aerospace industry, and they also make rocket components, rocket boosters and rocket engine components. So they're in a kind of a space that really is attractive. Aerospace is doing very well right now. Earnings are out of the way, and this is really an IPO, just came public a couple months ago in February, and it looks like it wants to break out of this base. Penumbra, this is also a device company. Again, this had a nice earnings reaction here, nice day here, and this structure here has formed a nice little handle. So it looks like it's ready to go. Gotten some good blue accumulation on the right side. that might be something to put on your watch list. And the last one is a one we're familiar with. This is GE Vernova, which makes gas turbines for infrastructure related to AI build out. This one had a nice double bottom here, broke out a couple days ago, last week, and it's continuing to move higher in a very strong fashion. Earnings are out of the way. So another one that is clear of earnings risk. You might want to have that one on your watch list. So there's a lot of things moving, a lot of things that are still setting up. So we really, really want to stay engaged. Now, it's important that if you missed a breakout, don't chase extended stocks. The market is getting stretched here. There's a lot of FOMO going on, and that's usually when the market's going to pull back. Now, I mentioned this to members of Rain King Insights last week that I was already starting to look at early sector rotations. And what I really was paying attention to are the home builders the last few weeks. You know, we saw this huge volume day back here that gave us a clue that maybe the sector was starting to bottom out. Now, since then, we've actually got a higher low in the HXB, which is the sector for home builders, which was encouraging as a second piece of the puzzle and with some nice volume spikes. Now, last week, there was bad news in the sector. The March home sales were down 5.9%. Its worst monthly report since 2009, but we got a good reaction in the market. The home builders were actually up on the day. And we always look and careful to how stocks are paying attention and how they react to news. When the news is horrible, but the sector moves up, that's telling you the smart money is starting to put their money back into the builders as they're looking 6 to 9 to 12 months out. So we looked at a couple stocks that I think look very interesting that may be bottoming. We looked at DR Horton, DHI. We talked about the higher low that we saw. And we also looked at Toll Brothers, which is definitely on our watch list. This one has earnings, though, in about 3 to 4 weeks on the 27th of May. DR Horton, the earnings are out of the way. I like Toll Brothers a little bit better here. It is running right up into the 50, so there could be some consolidation or work to push through this. But I really like the fact that we're seeing blue spikes. This is institutions that are starting to reposition in the home building group. Very early signs of sector rotation, and these might set up some really, really good trades. We're going to be watching that for the focus list at Rain King Insights. So I want to talk a little bit more about the Rain King membership level at the website. If you get a Rain King membership level, I do a weekly video of trade ideas, specific trade ideas with pivots, stop losses, position sizes, etc., and targets. I also give you my entire watch list every single Monday. Now, I've started this service last July, and recently we've been running for about 9 months. I've done some statistics on all the trades that I've put out there, and I'm proud of the fact that we have a 52% win rate in the trades, and the target risk reward is a minimum of 3 to 1. So we're not talking about a high win rate that's risk 1,000, make 1,000. We're talking about risking 1,000 to make 3,000. We're talking about risking money 3 to 1 risk reward. Also, over the past year, we've had members early into positions in Palantir that if they were properly held and properly handled, were up 300%. GEV was up over 100%. And you can see the balance of the names that were big winners last year. So if you're interested in trade ideas, you might want to go to Rain King membership level. At the same time, we have top quality educational videos. At the Rain King level, we look at advanced buying and selling, how to use historic precedents. We've got a 2-video series on how to short stocks, shakeouts and shake-ins, how to handle losing streaks, how to conduct advanced post-analysis. And believe me, there are dozens more videos within my website that you get access to if you're a Rain King member. So you might want to really consider that. It's something that we'd love to have you join us. All right, let's get back to wrapping up this week. All right, so where are we? Well, we had a follow-through day on the 22nd of April, and we got invested back into the market. We put our toes in the water, and we've had our first push above the 50-day. We're a little stretched here. I did mention I think it's going to come back in a little bit, but in a constructive manner. The 20-day, we've got 6 days. Actually, today makes 7 days above the 20-day moving average. So that's really a good sign. A couple other pieces will need to be put into place to get a power trend. So we're probably at least a week away from potentially a power trend getting in place. The new highs, new lows is probably one thing that has not yet fallen into place. We're starting to see a little bit of new highs, but it's not strong yet. It's still below the 50 levels on a net basis. I like to see at least 50. I really want to see 100 new highs per day. So we're not there yet. But with all the breadth improvements that we're seeing, hopefully that translates soon to new highs in many, many stocks. The leaders have certainly broken out. We showed you a chart that shows all the leaders that are really starting to run. And on our watch list, we have another basket of stocks that are setting up to also potentially break out. Exposure levels, we've increased them from last week. I believe 30 to 40% is where we want to be. We don't want to plow into the market and get 60, 70, 80% exposure levels when the market is this stretched, because we're going to just get hurt when the market does have its first little correction. So I think Wednesday was an important day. The market had the excuse to go down, but it didn't. We actually rallied. That's really helpfully revealing about some of the strength and conviction of institutions coming back in to buy the market. I mentioned, I do think a 3 to 5% pullback would be healthy, and it would be normal action and give us some pullback entries in our focus list names. And I repeat this almost every week. Don't buy extended stocks. If you have FOMO and you miss some of the leading stocks, you're going to have to simply wait. And hopefully you have a pullback strategy. We have multiple pullback strategies at Rain King Insights to help you get into winners that maybe you thought you missed. So there's a lot going on. So far, the market is improving, but we also want to take care of risk first. All right, our quote of the week is from Louis Roykaiser, the journalist who passed away back in 2006. In Wall Street, the only thing that's hard to explain is next week. So let's take every week one step at a time, and let's hope that the market gives us opportunities next week. That's the general market update for May 2nd, 2025. Thanks, everybody, for joining us. And please take a stop and check out rainkinginsights.com.